is section 3.1, reviewing workout options. These are retention options. So first, what is a workout and why do one? A workout's also referred to as loss mitigation, and the reason it's called that is because that's a reference to mitigating or reducing the lender's loss. We've discussed in previous sections how typically the lender or the servicer is going to lose a significant sum of money if they take back possession of the property and end up having to go through the expense of taking over possession of that property, trying to sell it, sending people to cut the grass and take care of it. And so typically they want to get the borrower a workout so that they can just receive payments and not worry about all that other stuff. So your goal in a workout is preserving home ownership whenever possible. In any resolution short of foreclosure typically is good, but most clients that you're going to encounter are going to want to keep the house, in which case you're going to be going for one of these retention options. So some things to consider ahead of time. Is the homeowner current but at risk of default? What do they want to do? Do they have a reset on an adjustable rate coming up in the near future? You want to see what their goals are in terms of seeking delay of the foreclosure sale, potentially getting that in writing. You want to know how much money is available for a workout. Sometimes clients actually have the money to reinstate the account, or they know a family member or somebody that's willing to do that for them, and that is an option. So just make sure you're reviewing all those things beforehand and understanding what the client's goals are. Some other things to consider: the condition of the property, what the property's actually worth. Is the borrower severely underwater, or do they actually have some equity in the home? Information about the loan. So you want to know, what's the term? Is it 15-year, 30-year? What's the interest rate? Is there a balloon in place? Is it an adjustable rate mortgage? All those kind of things. Then you want to look at, what's the principal portion of their payment versus interest, escrow, and then, any foreclosure fees and costs that have been assessed to date. It's important to know that those are out there as well. Some borrowers don't realize that they're going to potentially be on the hook for attorney's fees, court costs, all those sorts of things once the lender actually initiates the foreclosure process. Also, you're going to get the loan documents and screen them for any predatory features. If there's anything that you notice that's unusual, you may want to refer them to a legal aid organization or a private attorney. Who are you going to call? Well, first you're going to start with a servicer, hopefully someone with decision-making authority. Usually that's in a home preservation or workout department. Occasionally it may involve government relations. Sometimes people call their congressman if they're having an issue. General counsel, you're probably not going to have a whole lot of contact with any attorneys, but it's possible you may have some contact with the foreclosure attorneys. Okay, so first workout option here is what's known as a repayment plan. That's also known as a reinstatement agreement, and basically how that works is the borrower cures the default by making regular monthly payments as they're due, plus an extra amount to pay down the arrears. Repayment plans typically range from 3 to 18 months, and so the size of the arrearage is particularly important in these cases. If they owe a couple years of payments, it may be more difficult for them to have a realistic repayment plan in place. Forbearance plan. This is a period of reduced or suspended payments. It allows the homeowner to recover from the event that caused the financial hardship. So if they lost a job or had a medical situation come up, this gives them a temporary reduction in their payments, and then it's usually followed by a repayment plan or a modification. The bank's typically not going to forgive any of those portions that the payment is a reduced amount, so they're not going to forgive the balance that's owed. That's somehow going to be worked back into the loan. There's a forbearance followed by a repayment plan. It's typically, like I was just discussing, it's typically unrealistic if there's a large arrearage. So you want to ask questions about how long you think it'll take the borrower to get caught up, how much time does the borrower have with no payments or reduced payments, and then what happens to all those late fees, interest charges, all that during that period, and then what happens to a foreclosure. Is it going to be on hold during the forbearance as long as they get into a repayment plan, or how is it going to work exactly? Second retention option, this is the most popular one, the one that you're probably going to be working the most to achieve, and that's a loan modification. And it's just what it says. It's a change in the loan terms. That's a modification of the loan terms. So it usually involves a combination of the following things: capitalization of arrears, which means taking any unpaid amounts and adding them back into the loan balance. Adding delinquent interest, taxes, and insurance to the unpaid principal balance. Reduce the interest rate. So if they're at a really high interest rate, 7, 8, 9%, something like that, getting them closer to 4.5 or whatever the current market rate is. Often they'll be converted from a variable to a fixed rate loan. Clients typically appreciate that just because it gives them the added security of knowing that their payment's going to remain pretty stable into the future. Extension of the loan's repayment period. That's a possibility. The longest one that I've seen is 40 years. That's investor specific in terms of how long they're willing to extend the loan repayment period. But 40 years is probably about the maximum that you're going to see. And clients just need to understand the amount of interest they're going to pay with an extra 10 years on the loan. Reduction of principal balance, it does happen rarely, but it does happen, where the lender agrees to reduce the principal balance closer to what the market value of the home is if it's severely underwater. Borrowers appreciate that, but just realize there may be some tax implications if the borrower forgives the lender forgives a portion of what's owed on the account. Common features of a loan modification: usually there's a trial period. Most of them are 3 months or so. You make the 3 payments, and then the loan either permanently modifies or automatically, or you have to submit paperwork to the lender and then move forward making payments, and then the loan will be permanently modified and the foreclosure case dismissed. They do actually commonly reduce the interest rate below a market rate. Some loans you'll see reduced down all the way to 2%. You'll hear clients say, "Oh, I had a family member that got a 2% loan. How can I get that?" They have to realize very early on that it's not a negotiation. It's going to very heavily depend on who the investor on the loan is, and in that sense, it is possible in some circumstances, to get a 2% loan, but it's very, very rare. Commonly, those have step rates built into them where 2% is sort of the floor, and then over a term of years, the rate is stepped up until it gets to a market rate. Another common feature: temporary interest rate reduction. Sometimes servicers will agree to reduce the interest rate for a period of 6 months or a year or whatever it is, just to get the borrower back on their feet, and a show of goodwill that they understand that the borrower's in a difficult situation. Recasting, that means canceling missed payments and adding the obligation of those payments to the end of the loan, and then the loan is re-amortized. It's available on a limited basis, and if it is available, it's only used if less than 6 months, if the loan is less than 6 months behind. That is the end of section 3.1, workout options retention.